So moving forward with chapter 10, guys, I wanted to go over with this chapter, actually just looking at my online book here, what part of the chapter I really want you to focus on. So, what is a return on a loan? Primarily, we're going to talk about a base rate plus a credit risk or premium, right? And a base rate can be something like the federal funds rate, or what's been popular actually over the last couple of years is LIBOR, which is the London Interbank Offered Rate. And this is just the primary rate, which is the rate at which banks in Europe lend monies to each other on a short-term basis. And then it can have different maturities as well, the LIBOR, and it's in the offshore euro-dollar market. So the base lending rate is basically that, plus credit risk premium or margin, 2%, is basically the extra risk you're taking on beyond that. In other words, it's almost like there used to be a word called prime rate, which is like basically the base rate. Same thing. And credit premium is like the riskier you are, the more you have to pay. For example, US Treasury, very, very tiny above this rate. Corporate bonds that are highly rated are the next ones that are a little bit more after that. Lower rated corporate bonds pay a little bit more than that, and then so on and so forth. And traditionally, you can almost look at credit ratings, and the lower your rating is, the bigger your prime rate is for a corporation. Of course, this is more also for corporate, by the way, that we're talking about. And we're going to get into retail in a little bit. There was the rigging of the LIBOR rate, which banks just settled for paying $5.8 billion. The five biggest banks or so were actually rigging this rate. Even a small uptick in this rate was making them a lot more money because all the loans are tied to the LIBOR rate. The compensating balance, guys, I don't want you to get too involved with all this math, because the reality is the return on the loan is really, really very close to the prime rate plus the margin. I think what he's computing here is if they, sacrifice some deposit as well and do a collateral deposit and then gets invested into something else. We want to get the big picture here first. I want you guys to focus on that. So, retail versus wholesale credit decisions. Basically, we're talking about consumer loans versus commercial and industrial. In consumer loans, you're talking about a car loan, credit card loan, mostly. And keep in mind, those are driven a lot of times by your credit score. With retail, with credit card, with auto loan, what they do is they get your credit report from, I think there's three companies: Equifax, TransUnion, and I forget the third one right now. But they all do the same thing. They basically accumulate a credit score for you, and for everybody, for individuals, and they sell that credit report to banks who look to make a loan. But that's when the bank can make a wiser credit decision. So we'll get into what actually there's more drivers to that than that, actually, and we'll talk about mortgages and real estate as well. For wholesale, which I will have our discussion focus on this week, for wholesale loans, it's more about Moody's and S&P doing the credit analysis and really analyzing what is the risk of default, what should be the premium, and what drives the rate. And this is based also, talk about the factors, but primarily companies that have a strong balance sheet, strong earnings, have very high ratings. And companies that already are highly leveraged and have a lot of debt and are struggling with earnings are going to have lower ratings. And then essentially the less money you have, the less earnings power you have, the higher likelihood is that you're going to default on your loan for a corporation. And this is a big market in terms of ratings on the wholesale end. And we're gonna look more into that. I actually have I was just looking at a specific loan on Moody's here for Exxon, and I'm gonna find a more detailed report maybe in our library to go over with you guys and post it on tomorrow night or Friday morning, and basically to connect on what is going on here in terms of a specific company credit report. And it talks about the strength of their company and talks about how well they're doing. And I'll find one and I'll post it. And that's actually will be our discussion this week, is to research one company's credit and to post your findings. So basically, what provides for the default risk model? Where does the default risk model really fall? And the borrower-specific factors, and then there's business-specific, market-specific factors. So we're going to go over reputation, leverage, volatility, collateral, and then we're going to go over the business cycle and the level of rates. And then there's quantitative models that at the moment we're going to focus on the qualitative here. So for borrower specific, you could have reputation. Are they reputable? Have they repaid in the past? How have they been doing? There's a record, there's a history, as we were saying. Leverage. What is the borrower's capital structure? In other words, do they already have a lot of debt? Do they have very little debt? How much credit do they have? How much of that credit is being used? So volatility of earnings. The idea is, how much are they making? How regular is their income in terms of this? Is their income growing? So these are kind of things that you're interested in as a lender, about your borrower before you're going to give them a loan, or how big of a loan you're going to give them, and what rate, more importantly, you're going to give them. As you see here, as the debt to equity ratio grows from 0 to 100, there's no real effect on probability of default until 50, and this is a debt to equity ratio is basically, the amount of debt to your equity as a percent of total financing. As you have more and more debt, the probability of default grows quite sharply. So you could see that is a factor. And then collateral. In terms of collateral, what are you putting down in terms of whether it's a car loan, so you don't really, the car acts as collateral. It's a house, the house acts as collateral. And for corporate loans, sometimes, their assets basically act as collateral. So basically that's where collateral becomes a very big deal, because it signifies more security to the lender in case of anything in terms of non-performance or default. The market-specific factors are the business cycle and the level of interest rates. Of course, when there's a recession, you have to be much more careful in lending, and maybe, of course, they request more collateral, or they lend less, as we saw after the housing crisis. It was impossible to get a mortgage sometimes for certain people. Level of interest rates, also you have to look and see if there are high rates like there was in the 80s, people are much more likely to default, or when in 08, 07, when those adjustable rate mortgages were going up, the higher rates were making people default as well. And then from the quantitative models, there's the credit scoring models, which we discussed a little bit, and then there's these other models, and this is the highly mathematical stuff right now, guys, is beyond the scope of this class. Again, this stuff, you can look at it in terms of optional reading with this, but this is beyond of our scope. There's just more of a overview of the stuff. And also this course will be in the context of just general corporations, not just banks. So this is just giving us a flavor. Now for measurement of credit and pricing, in terms of what Moody's does and S&P does in terms of ratings, I am going to, in the next video, go over a report. And I just looked at Exxon briefly to see what's going on with them, but I'll find a more detailed one, and then I'll post to your assignment for the discussion for that. So stay tuned for that.